So let's get started, shall we? As people, our next speaker has taken an active part in the previous discussion, Raphael Douady from CNRS, and also a firm whose name escapes me at this point. What's it? RiskData. There it is. RiskData. Great. Yeah, he's going to speak to us.
I put it's good. The microphone works. Yeah. You see, I have 5 affiliations.
Very good. And I'm going to speak to us about capital adequacy, pro-cyclicality, and systemic risk. Pretty well everything.
Well, first, probably like everybody, I would like to thank the organizers and the Newton Institute and for organizing this very, very interesting meeting and inviting me in it. And as you can see, and this meeting shows it, mathematical finance have really deeply evolved since the crisis, the 2008 crisis. I mean, there is a before and an after, definitely, in our... and in particular, there is this question, I mean, generally speaking, the question of dynamics. I mean, there was something which was absolutely commonly acknowledged, admitted before the crisis. All the models had purely exogenous sources of risk. We start from some asset that has a Brownian motion. We can discuss whether it's a Brownian, whether it has shocks, whether it has that, but it was exogenous. And then suddenly people said, no, there is some endogeneity in it, there is some dynamics, there is some feedback effects. And they started looking at that. Now, at the same time, they said, okay, we have to have tighter regulations because they were much too free. We have to control many things, and so we built new regulations. There was all the Dodd-Frank things, and Basel II became Basel III. Since the beginning, since the very start of the beginning, I've been warning on how ill-conceived was Basel III, because instead of reducing the endogenous effects, the pro-cyclicality as they call it, I mean, I'm coming from dynamical systems before doing finance. In dynamical systems, we call it simply, unstable instability, that's those increasing feedback loops. And you'll find out that there is some inherent instability in markets, and having a capital adequacy rule that at least doesn't increase it, if it does not fight it, is possible, but it goes the exact opposite way as what was done with Basel III. So, what is the feedback loop? It's something pretty simple. There are 2 of them or 3 of them, but typically this one is related to capital adequacy. It's when you have a risk factor, can be the market, whatever, you just observe some type of jump. And of course, immediately, the risk measures react to the new regime. That changes the regime, and the risk factor react. The volatility increases. For the exact same position, you're a trader, a bank, whatever, your value at risk increases. Value at risk increases, then it goes beyond your capital. You get a call for capital, because your capital is not free. You don't have it like this. You don't invent capital. On the contrary, your assets tend to decrease at that time. So you have to cut positions. So you have to put sell orders. And of course, sell orders put a liquidity crisis that even makes the factor jump even further. So this is something where you see that the existence of a regulation that links the amount of required capital to the evaluation of the risk is something that increases the instability, even though there was some other type of instability. Let me give you two examples. This is coming from what I call a myopic risk estimation. What is myopic? Is that the risk is something that is supposed to be estimated, I don't know, I mean, when you take your car, you take a plane, and you want to evaluate what the risk of doing so, you don't think of some measure of the statistics over the past, the recent past. You will take into account the fact that cars are, for instance, safer because, quote, because they have been designed with more recent technology, same for the planes, etc. But the statistics still remain, something that you look on the long term. In finance, people say, well, the shorter term, the more accurate are the statistics. That's basically what you see most of the time. And the consequence is, and you even see, people saying, okay, well, I should measure to get an accurate measure of the volatility of markets, I'd rather take the implied volatilities. Well, implied volatilities are even further volatile themselves. So I was showing, two examples of those instabilities stemming from this myopic risk estimation. The one is just the one I described, regulatory pro-cyclicality. Another one is well known, is the Minsky instability. Minsky instability means you have a drop in asset value, therefore you get downgrading. And because you get downgraded, the market will impose you higher interest rate on your borrowings. So you get an increased debt burden and a disbalance in your balance sheet between assets and liabilities. Therefore, the solvability is at stake. Therefore, you get even further downgrading, etc. That's exactly when going from what is it called, a hedge category. I mean, I'm using this Minsky wording, hedge category of borrowers to Ponzi category of borrowers. And this is the second one you have to know is absolutely inherent to capital markets. I first thought, okay, it's a problem of mark to market. And then you realize that if you want to drop the mark to market, the fair value, you can. I mean, you can find it, and there is an enormous debate among the accountants on how you should mark assets, etc. But this is in the essence of capital markets. It's like, speculative bubbles. You don't have capital markets without speculative bubbles. Whether you want to tame the damage of those is a different question. So I don't want to go into this deep discussion, but I want to see how we can build a regulatory framework that, instead of aggravating this, gives you the tools for mitigating, on the contrary, this pro-cyclicality. In some sense, what is so this is, I found this picture. I mean, we found together with Marco, so that's why he's laughing. He remembers it. I mean, it was, believe me, it was in the Financial Times. Look at the date, 1998, not 2008. So it was by the time where the people first spoke of systemic risk, and the first event when people started to use the word systemic risk was 1998 with the LTCM failure, so the long-term capital. And at that time, of course, I mean, I doubt that long-term capital was a real threat to the world economy. Compared to what we see today, I mean, it was something like I mean, the first figure announced was something like 4 billion, and then eventually it came down to less than 1 billion. So when we see the size of the market, it's ridiculous, and because of course after when SocGen had Kerviel, so no, it's not a problem, it's just, and when BNP had 9 billion, oh, we absorbed that, no problem. So, but that's when it came, and it is very true today, very true. Huh? I mean, that's, you have, people tend to be in the dark, and the reaction is, we want to control everything. And I saw one guy in a conference recently with a picture that was absolutely extraordinary. You see, you know, the world is safer, and then you see a big. I mean, in order to fix a problem of an enormous highway with huge traffic on it, and cars were like this, you know, the highway, instead of the cars, it has tanks. So, if we go down to this capital adequacy, you will see that the capital is defined as a multiple of some risk measure, which you can call value at risk. I mean, that's the one that has been adopted. You can change it to different types of risk measures, but it's always a multiple of the risk measure. The risk measure is supposed to be measured by the financial institutions, controlled by the regulator. So the regulator will make sure that the financial institution measures the risk measure in a correct manner. And we'll see, you know, the importance, every single step is important. The way it is controlled is very important. And K is a ratio, a multiplier, that depends on how well those risk measures are on the quality of the computation of the risk measure, and specifically, so there are different aspects that are controlled, but one of the most important one is the backtesting. So in the case of value at risk, say it's a 99% value at risk over a 10 days period. So they will look at 10 days period, and they will check that this 99% is not overpassed more than 1 day out of 100. What happens on that day, nobody cares. If you can overpass it by 10 times, it's not a problem. As long as it's just 1 day out of 100. Or 2.5 days out of a year or something. So you just count exceptions. You verify the independence of violations, that is, because it's 10 days period, so violations that are more than 10 days apart should be independent. And so if you look at it, the way it is backtested by regulators put absolutely no incentive for any effort to anticipate crisis. So I'm a bank, you know, I'm just, you know, trying to, what is the tendency today? The tendency is, instead of putting more responsibility on the financial institutions, is on the contrary to retrieve responsibility. That is, to give me more information, me as a regulator. Now I'm the regulator. Instead of receiving, you know, some files, you know, with risk reports and profits and losses, so that I can verify that, I receive zillions of data. I'm totally overwhelmed with data and just don't know how to do it. I don't know what to do with it. But I get financial institutions who can say, well, you know, I gave you absolutely everything. So if something's going wrong, it's not me any longer, it's you. The way that would be, I think, healthier to look at it is to remember that this risk estimate, any risk estimate, is always a product of two figures. One is a move of the sum risk factor, what I call a market move, and one is the sensitivity of the institution to that market. So whether that market is equities, interest rate, credit spread, anything, you always have something that produces and the shift, and something that reacts to that shift. If you're driving your car, there is an external shock to your car. It's not external to the market in general. It's external to your car. And then there's a reaction of your car to that external shock.
But the question, VAR expected shortfall are
VAR,
of this type. They are not of this type.
absolutely, VAR is of this type.
You weigh all, take all the risk
Whoa, 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 whoa.
they're weighted, the probability.
Absolutely, absolutely. So it's a combination of those things.
But sensitivity, I have another question. Sensitivity implies a model.
I agree. VAR also implies a model.
Okay.
Okay, VAR is a risk measure that you come out of a distribution of a portfolio. You get a portfolio, even if the portfolio is made complex, has some trading assets, some non-traded assets, etc. So your portfolio is made of different types of entities. Now, the VAR is a risk measure out of a distribution of the returns of a given portfolio. That portfolio is a sum of different assets. Each asset has this type of behavior. So, basically, you can always reduce the risk to some reaction of things of this type. Now, the global philosophy that I would like to, that I think would be much healthier than having this global VAR measure is to separate those two sources. That a financial institution, I finish my sentence, I give you yours. A financial institution should be responsible for measuring its reaction to any market factor, and I think this is essential. You laugh, I spoke to different responsible at high level of different banks about this proposal, and their reaction that's, oh, it will cost us a lot to answer to your question on the sensitivities. That means that the banks have put in place, enormous risk departments to compute the value at risk. They are not able to tell me what is the cost of every point of the S&P, all together, all aggregated, which is, I think, a simple question like this one. And on the other side, a bank should not be responsible for knowing whether the market is going to drop 10 or 15 or 20%. That is something that is not in the control of a financial institution.
Yeah, I mean, there are examples where this is done. For example, if you look at how the default fund of CCPs, the guideline of the regulator is you should have enough funds there to cover two-member defaults. So they define the scenario, two-member default.
Two-member default, yeah, that's one thing.
You don't decide what the default probability of members are. We say two members,
No.
and then you compute your sensitivity.
Yeah, and this is two members. This is two members. That's not what I'm talking about. I want to say, okay, two members is okay. Well, you get. It's like do you have that in the industry? Why do you have planes with 4 engines? Because they should cover the case where they have 2 engines falling.
I'm saying this is an example, but if you look at a portfolio of context,
Yeah.
I don't see how you can do that. You have a long list of risk factors.
I will give you the answer to this one.
Editorial problem.
Yeah, no, that's another problem. No, I will come to practical solutions to
I
answer
think we
that.
should let the speaker.
Yeah. No, but I wanted to, so Marco wanted to say
Okay,
something.
rather than discuss
That's okay, Marco.
ad nauseam as we go along.
Marco, you had a remark.
No, I think that
Remarks are okay.
the first equation that you have there on line 2 leaves one thing open. Who determines the sensitivity? The bank. That means that there's a model. So I think that what you're saying.
Wait, I come down to that.
Who puts the model?
I precisely come down to that.
Let him answer.
That's exactly okay. No. So in fact, in the current setting, banks have their own model to produce a distribution of their global outcome, and then they say, okay, my value at risk is at this level. Then there is a procedure in place, that is a public procedure, It's like, you know how you are going to be tested, and regulator says, okay, I'm going to test you on this and this and this particularities, and basically number of exceptions, independence of exceptions, and also on the process, the separation of it's more like governance specifications, and I'm telling you this is good or this is bad according to this process. So I will follow exactly the same thing. I don't care the way you are going to tell me that, but I'm telling you how I'm going to test you. So that's exactly the topic of the whole proposal. So that's why I say separation of roles. Institutions ought to know their sensitivities to all possible market moves. And that is, in terms of governance, I think this is absolutely essential. Not only they should know, but this is what they should report. Not their risk. They should not say, my risk globally is XYZ. They should tell, okay, let's say beyond a move of 5% of the S&P, every point costs me this. Beyond a move of the credit spreads, every point costs me this. Beyond a move of interest rates, of long-term rates, every point costs me this. This is how you should communicate the risks.
But why? It could be very nonlinear.
Yeah. That's exactly, and you should precisely communicate those nonlinearities. Okay. That's exactly, and more importantly, the asymptotic slope, basically. This is what I think is the important thing to communicate. The way that slope comes from out of options, out of whatever, and your model is like for the VAR. You're responsible for your model. As a regulator, I will check that you do a precise, a good job, and that I will going to show you how you do a good job. But I want to give you
nonlinear.
Absolutely.
If I give you my sensitivity to A and to B, even for
I'm going to that. I'm going to answer all that. I'm going to precisely answer all that. Believe me, nonlinearity, that's my milk. No, I just want to show you the importance of that. And suppose, okay, you go to a doctor, and then bad news, you get a brain tumor, and you have to go for surgery, and it's a very dangerous surgery. There's plenty of things, and now the doctor needs to know how he's going to deal with you, and in fact, I mean, you see that in that case, I mean, somehow, the doctor is asking you to make a decision, so he has to communicate with you to give you the information for you to make a decision, which is an essential decision because it involves your own life. Now, I give you two types of doctors. Dr. A, he tells you, well, your brain tumor, here is an image, your brain tumor is exactly here, and I'm going to use this type of technique, blah, 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 use in that case, and I'm going to do exactly, this type, I'm going to use an instrument of this size and cool down your brain to the exact temperature, and so in details what he's going to do. Okay, so do you want me to do it? Or? The second doctor does not give you as many details. He just tells you, okay, well, I can remove the tumor, I can basically intervene. If I don't do it, well, statistically, here's a chance that you can live with it, or here's a chance that you're going to die, and what's life expectation. And if I do it, well, there is certain probabilities that you stay there, certain probabilities that you wake up, but you will be blind, or you will be mute, or here's the possible outcome, and if I cure you, here's your life expectation, etc. So he gives you, this type of information without giving details on what he's going to do, but giving, some statistics on the outcome. Now, what is of the two doctors, what is the most helpful for you to make a decision whether you are going to make the surgery or not? Obviously B. So that's exactly what I'm telling you. I mean, it's for a regulator, I'm rather having institutions that tell me what will be the outcome if, rather than global picture like this, you know, and so this is exactly this type of consideration. So one of the big problems precisely with the blow-ups and the systemic risk is the buildup of bubbles. So it's important to have the possibility for a regulator to anticipate bubbles. Bubbles stem up out of concentration of risks. So you see it if you get the risk estimate in terms of sensitivities. Whether you have to simulate a drop in the market of 5, 10 or 20% depends on whether we are in a bubble situation. So you need to get this information. In the case of bubbles, the regulator can then, therefore, you know, see sectors that are overexposed, anticipate that there is a potential bubble in this sector, even if the volatility is not so large, and therefore specify higher risk factors. And because you specify higher risk factor shift in this, you make the investment in this exposure to this to those risk factors more expensive. And therefore, you have an incentive to smoothly deflate a bubble, rather than, you know, suddenly saying, "Oh, I got the bubble, so I have to cut off all the position," and then you enter into the pro-cyclical dynamics. So, how do you do that? Precisely, the regulator first issues a list of risk factors that all financial institutions should report. And for each risk factors, it will say, okay, here is a list of stresses that I want you to post. I'm not telling, okay, well, so I put here round figures, 20, 10, 0, 10, and things like this. And you see that I put different stresses, not necessarily aligned, precisely to account for nonlinearities. They are identified as precise figures, BA, credit spread, 10 years rate, etc. Although I know they are correlated. Now, what I want to see, friends, when I put S&P 500, of course, it's a move of the equity market. I'm not asking you to simulate all equities. It's not an accounting figure that I'm asking you here. It's a risk figure, and that is very different. I'm telling you, put yourself in a case where the S&P is dropping 20%, and you will see why I'm asking this question when I'm going to show you how this will be backtested. Put yourself in the situation, in a scenario where S&P is dropping 20%. What is the likely impact on you? If the S&P is dropping 20%, what do you think will happen to other risk factors? I have no equity exposure, I have only fixed income exposure. What will happen to me? Zero? Certainly not. Because in my fixed income exposure, I mean, the S&P dropping 20% is a very serious crisis. So that day, believe me, all credit spreads will blow up. All implied volatilities will blow up. So if I put myself in that scenario, it's very likely that many things will happen. But as a manager of a large financial institution, if I'm not aware of that, I mean, I should be jailed. Okay? So as a manager of a financial institution, I should be able to answer the question, what will happen if the S&P 500 drops 20%? What will happen if credit spreads increase by 200 BPs? Even though those two scenarios they are different scenarios, because I will. So my role now as a so the regulator issues this matrix, and as a financial institution, I'm supposed to put a figure in every single box. Now,
That's going to be a large box.
I mean, you may have about 50 lines, and 5, you know, that's no, I mean, with respect to what is done today, that's nothing. Absolutely nothing.
But that's why people do Monte Carlo, because you cannot get the table with millions of
But I
numbers
think-
for each
Well,
factor.
what do you say, millions of...
Look, you have, let's say you have 10 risk factors. Only 10 risk factors.
Look, I have 50 risk factors, that's 250 figures that I'm asking you, that's all.
So you're saying that, this is very important, you're saying that a scenario is one in which only one risk factor moves? Is
No,
that
no,
the
That's,
scenario?
no, you just did,
Scenario is a column.
Rama, for once, that's the fourth time you're listening to that talk.
But you never
So I think you're stupid.
The scenario is a column. It's a column.
So what I think he means is that when you do the Monte Carlo simulation, you just grab the scenario that the S&P 500 factor drops 20%.
You have a bank with 1 million position.
Okay.
1 million position, each single position will react in a certain likely manner to a scenario where the S&P is dropping 20%. I'm not talking of an accounting figure. If I have a loan, you know, if I have an IBM loan, and it happened that likely with the S&P falling 20%, the IBM spread will increase by 200 BPs, I will account that into this. That's an expected figure.
It's from the model.
It's from my model.
But forgive me, you've obviously never actually talked to anyone from a big bank who's had to run stress tests. It's incredibly difficult to do that.
I know that.
Even in one scenario. And you know, you talk about the S&P dropping 20%. What do you mean? In a day, in a week, in a year?
Yeah.
And if they had to report this to the regulators, which would basically mean they could be jailed or fined if they got any one of these numbers wrong.
That's exactly what. Okay, now we're coming to it.
How much work?
Yeah, no, we're coming to it. No, that's exactly it. No, you're on the right point. You're on the right point. On the one hand, indeed, I mean, it's difficult. It's difficult because the mentality is not there. Ask any trader who has, you know, all his options position. They know exactly. They are able to answer to that question.
Only to first order. Nobody can predict what
That's sufficient.
order effect of a drop of 20% of the S&P would.
Sure. They know. No, they know perfectly. No.
Why don't you just take your portfolio and put it through Lehman Brothers month? You know, like from September. Then put it.
That's exactly the idea. That is exactly the idea.
Do that.
Now, okay, how do you backtest as a regulator? And I think the whole answer is about the how do you do it with a regulator. The idea is the following thing. This is what you report on a given factor. Now, basically, what I want you to make a reporting in such a way that whatever happens to you, you have an excuse. I'm asking you to have excuses for what happens to you. You may make or lose money, but whenever you lose money, you should tell me, well, you know, I told you already that if such and such factor drops, that may happen to me. So you should not be surprised that I lost 3% because look, on that day where I lost 3%, in fact, there was a move of the European equities, and I told you that in that case I could lose 5. You've been lucky, I lost only 3. So basically, this is what. So you want that any single return, any day, should be justified by at least one of the figures, because the risk, your capital adequacy, will be based on the worst stress test. So you have this big array, just take the worst figure. So you see, I'm not combining them. I'm just taking the max. I'm not aggregating those risk figures. I'm not saying, okay, you risk 5 on the S&P and 2 on the credit spread, therefore your risk is 7. No. I'm just saying, okay, what's the worst thing? Because the two may go together.
So how many scenarios are there? 5? You have 5.
Yeah, typically, I mean, that's what, everything can be discussed, but, I mean, it sounds like, maybe, even 4, because you want to have, in fact, basically you need 2 on one side and 2 on the other side, because what you want is to have an asymptotic line on each side. That's the most important. Because now, suppose there is a black swan on one day, and you have a huge drop. As long as you just, extrapolate those 2 reportings, and if when extrapolating you are within the limit, then, in fact, I don't consider this as a violation. It's just bad luck. Market dropped too much, and that was not your responsibility. Your responsibility is the slope of that line, which is your exposure.
It's true that as you report, I still don't get it.
Yeah.
So let's say you have 2 risk factors, only 2.
Yeah, okay.
So you stress risk factor number 1,
Yes.
it moves down 20%.
Yeah.
But they are correlated in the model. So now you have set scenarios. If you did Monte Carlo, I don't know if you do it, you will get scenarios where one of them drops this scenario 20%, but the other one can do a variety of things. It can go up, down. So what do you exactly report here?
The average?
The average.
No, I would report precisely. I would report the like a value at risk of what happens to you, a conditional value at risk, but not a real conditional value at risk in the wording, not the CVAR.
So it's a 99% quantile of the portfolio conditional on this value of one risk factor.
Some. I'm not saying 99%. I wouldn't be surprised.
Something like that.
But basically, okay. Well, some downside of a confidence interval.
But you realize that there's still the combinatorial issue. You will have a huge computation there, right? You have a huge computation there. I mean, we have looked at cases where you have, just to run the unconditional VAR, you need hours. Now you need to run this conditional VAR for every risk factor in every scenario, 50 or...
Okay, well then if you have problems, I can show you the RiskData system, it will solve that.
No, we can't.
If this is your problem, I have the answer, which is another type. No, basically, okay. So what is important in the idea is that if there is a Black Monday or 2008 crisis and the market drops 40%, and then you lose an enormous amount of money because of that, well, basically, as long as you have reported your sensitivities, as a regulator, I'm okay with that. I won't penalize you because of the market. I will penalize you because of a misreporting of that slope. And you see here that it's more complicated. The answer to your question is more complicated because I'm asking you some here, not only the figures here, but I will use those figures for extrapolating. So you'd better use a confidence interval not only on the values but on the slope, because you know that you are going to be tested on the slope.
That's putting a lot of trust in the model. You need to trust the conditional tails of your model.
You need to test, what is the likely, basically, that's I'm going back to that. What is the cost of every point beyond a certain stress?
For these extreme levels, we have incredibly few observations, so it's a very difficult scenario.
That's where it goes back. I mean, if you have to put in basically, okay, I'm a banker, and I have thousands of trading tables, trading desks, and I have a whole division of the bank whose role is to compute the risk. I'm just saying that the philosophy is the wrong one. That's why all your answers come from the fact, I'm not trained for that. I'm telling you should completely shift the philosophy and make it closer to what is a common industry practice. You should go, to hospital, you should go to the airline industry, you should go, I've been working before in the airspace industry. It's a completely different philosophy. It's all based on scenarios. It's completely based on scenarios.
But for instance, span, the old span that we all...
The old span is close to that.
Scenario.
But yeah.
So, so you're advocating that we go back to span?
No, because span is oversimple. Here, okay, the implementation.
Relationship between your model and span.
Let's see the model first.
No, but he just showed the model. I mean,
No, because span, because basically, I'm telling you, okay,
show the model.
span would be one possible answer and certainly not the best, but one possible answer to that type of question. So the implementation, so institution can use additional factors if at some point, suppose, my joke is to say, okay, suppose you're exposed to Kazakhstan equities, and it's not among the list given by the regulator, but you fear that if there's a crisis, you have a big impact on your portfolio. So you can add it and report it, even if it's not asked for. That will account for your global capital adequacy. And you report that sensitivity. Say, okay, well, on top of everything you asked me for, I have that additional risk factor, so that if ever there is a crisis there, you can post and say, okay, well, I told you this was due to this risk factor which was declared. Now, you can also add. Divide your institution into different divisions and say, okay, well, I have this reporting for my activity, as a intermediation, this reporting for my proprietary trading, this reporting for my private equity activity, etc. And on top of that, you can find that finally, if you do it this way, you can have a specific division to account for operational risk, to account for different types of risks, could be accounted for into this way of reporting. Why does that eliminate pro-cyclicality? The regulator decides for the stresses. So basically, when there is a risk of a big crisis, the regulator can, it's exactly like the Fed saying, okay, we are thinking of increasing or decreasing the base rates. The regulator can say, okay, we are under surveillance of the risk for this particular sector. Be aware that our next communication in 2 weeks from now will post maybe a higher size of the stress, so that you should anticipate that possibly you will have an increase. So you tell people in advance. There is no surprise. They're missing a... Yeah, I forgot to say something important about the penalization multiplier. There is no, if you do this way, you don't need to say my capital adequacy is 3 times the VaR. You can say just capital adequacy is the maximum stress that you are reporting here. So only if you violate, that means that one of your losses is beyond all of the declared losses. In that case, you will be applied simply that size of violation. If you violate by 10%, your factor will be 1.1. If you violate by 20%, your factor will be 1.2. If you violate by 3 times, your factor will be 3. And then you get dampening until it goes it goes down towards 1. As long as there is no further violations, every further violation will bring again the factor to. So this is the way basically you pay on the size of the violation. Why is it important? That's why I put this little plane. The monetary policy is purely based on money printing. So basically, the issuance of money, bank credit line, lending and repo rates, and the government policy. I mean, Keynesian stimulus. Today you cannot print more money than is being printed, and interest rates are at zero. Basically, you cannot. You're in the limit. You cannot do anything as a central banker to monitor the policy. You're basically like this. So.
We are in,
What?
in Europe.
Sorry.
Yeah, in America they're like this.
We can buy bonds.
Yeah, exactly. But buying bonds means printing money. Okay, well.
Please go here or
Anyway, basically in here I'm offering the flaps. I mean, I'm telling, okay, without doing any of those things, I'm still giving you the means to put more money, into the different tiers, into to differentiate the cost of capital for investment in different areas, so that you can, re-equilibrate the markets.
You're now touching on a really important point, which I thought Philip's presentation yesterday was very good on. That you're suggesting that the capital adequacy should be a function of somehow the impact of a particular investment in the real economy. So I think it's a real.
Well, no, it should be accounted. It should be taken into account. I'm not saying it should be a function of, but it should be taken into account.
Exactly so. But all you've been talking about so far, in common with most of the literature, is looking at the capital adequacy purely on the basis of the financial risk to the bank. I think it's actually really important that we consider whether capital adequacy is
absolutely
the externalities.
Absolutely. And let me launch, on this occasion, an invitation, because I will be running with the LabEx and the INET in April in Paris, a whole conference on that topic, which is regulations and growth.
How do you do that?
Well, for instance, Marco, the capital that is required for the different tiers.
The first externality is employment in the United States. So, so far we are still in
no, but there is nothing as easy as a Phillips curve. That's something very, very complicated.
Very clear why the government.
Conceptually.
Well, this country invented this racket, so now.
Now, okay. Well, another thing. Okay, my last slide will be this one. I have other slides, but let me finish on this one,
I think
which is
mingle the discussion and the slides.
The last slide is really the fact that by reporting the sensitivities, and if on top of that you want to go from Basel II to Basel III, no problem. You can report sensitivities again of financial institutions to one another. That is, instead of saying, okay, the fact that Basel III put some capital on counterparty risk you had some pro-cyclicality at the global level. You introduced pro-cyclicality at the cross-financial institution relations. Now you had some systemic risk due to these loops that I was describing. By putting the same type of loop at the level of every single institution by the CVA, you've made the whole system a real atom bomb. And the case of SocGen in 2011 was stringent. There was some doubts on SocGen, and within a few days, the CDS went from 100 BPs to 400 BPs. Now that means that's exactly this type of loop because I had some friends, who were really in the industry at that time. They got a deal from SocGen to get they got a deal to protect their deal with a put from SocGen as a guarantee on their deal on the oil or something, and the investors refused the put. They wanted SocGen to be guaranteed itself by another financial institution. So just to show you what happens in terms of business to a financial institution when you are entering the loop at the level of, because simply, you had this capital requirement on every single cross-institution relation. Now that means that SocGen was for about a week at risk of bankruptcy. SocGen being bankrupt, it's about the same thing as Lehman. One institution of this size, it's a sci-fi. One institution of this size would have an impact on the financial. So basically, Basel III has introduced this type of risk, which was not there in Basel II. Now, on the contrary, by doing this type of reporting, you get the sensitivity. At least the regulator is aware. Second, it can run simulations. It can put the cushions needed. It can put some warnings. It can take the time to deflate the risk. So it's very possible now, as a regulator, instead of receiving zillions of data that are almost impossible to monitor, I get sensitivity data, and sensitivity data, these are files that are very easy to process. And believe me, I've built a risk system, so I know what it means. It's really easy. It's way easier to process a list of files of sensitivities. But sensitivities, mathematically, they're all the same types of figure. They are not complicated assets. It's just, it's an asset for which you know exactly how it behaves. So you can make Monte Carlo simulations now. You can look at impacts of, contagion impacts on different financial assets. And you can get an estimate of the global systemic risk and get warnings. You know where it comes from. You can pick up your phone and phone to the right guy to lower down such or such sensitivity that is creating systemic risk.
Okay, so now I have the list of my sensitivities to all the factors in the universe. So your title contains capital adequacy. What do I provision for? Do I provision for the sum? Do I provision for the maximum?
I told you the maximum.
The maximum of all sensitivities across all risk.
Not sensitivity, the maximum of all impacts.
Yeah, but the maximum of impacts to single risk factor. But what if two risk factors move at the same time? Why? Because
they are correlated and you have accounted. The practice is the following, and the rationale is the following. In large moves, risk factors tend to be very correlated. So basically what happens is that if you correctly report the thing, and as I'm telling you, if you account for those extreme correlations, then and you have no choice to doing it because you have.
Then you shouldn't take the max. Then you should take.
No, on the contrary. No, because okay, take the example of I have one equity and one bond. Very simple example. My portfolio is made one equity and one bond. One corporate bond, which is most of the time uncorrelated to the equity, but if there is a big drop, they come to 80% correlated, say. Okay, so now you simulate 20% drop of the equity. And that will likely impact the bond by 100 BPs. So you account for first scenario, 20% drop in there, and 100 BPs in the bond. Now, I'm asking you for 200 BPs in the bond. So and 200 BPs in the bond means, let's say, 10% on the equity. So you will simulate a second scenario with 200 BPs on the bond and 10% on the equity. Now, okay, you will report in that case the max of the two. Whereas you are talking of a scenario where I have both 20%, and 200 BPs. First, I could say, okay, what is the likelihood of that scenario? Maybe the two together, it won't be that, but it will be 150 and 15%, which altogether will give a figure close to the max of the two. And second, okay, so I could say that this 2020 is slightly beyond. The most important thing is that I'm in the good ballpark.
Yeah, but I mean, you cannot bound the quantile portfolio or by the max of conditional quantile.
I'm not asking to quantify. My problem is not to have a capital adequacy that will be, the capital adequacy is never accurate. The VAR is never an accurate figure. It's by definition a fuzzy figure. Why do you simulate 20 and not 15 and not 25? That's the whole fragility question of Nassim. Why do you simulate 20? Okay, you're asking me, okay, I put 20%. Okay, as a regulator, I know that, there is people will do the max. So I will give you, one single factor, I'm going to give you 20.
I think it's good to know the sensitivities. It's good to know the list for risk.
And on top of that, I want to have such figure. I know that the people will have to put aside certain. I know that in that case, the capital that I'm going to ask you, first, it is stable, and second, it has a property that it will cover most of the thing.
It's a good figure for risk reporting, but that's basically what stress tests do. But people are unable to consolidate the results of a stress test with the VAR or other measures of capital adequacy because they don't know. You take the max, you take the sum, you take.
No, but that's what I'm asking you. Forget about the VAR. Forget about that.
Okay.
You just use max of the. You just have to have enough stress tests, but it's a max about stress test. In other words, okay, let me give you an example.
I'm cognizant that there are several people who would like to speak, and I'd like to give them the chance to ask their questions. So, I mean, we've been through this several times. So,
Order.
in
the courtroom. Two questions. In your plot with the black swan, you said you want the banks to account for their slope, but if for increasing market shocks, the slope.
No, that's correct.
If it's concave.
Yeah, no, that's correct. Okay, well.
That's the first one. And the second one is, you said regulators should do less data mining, but if you look at counter-cyclicality from a different perspective and you say, okay, regulators do data mining and they see, oh, AIG has a huge buildup in CDS position, now we will be counter-cyclical and we will increase risk weights of the valued risk or the Basel II weights on any housing-related and asset-backed securities by housing. Then you have this counter-cyclical procedure while banks can still simulate. How would that approach?
Okay, two answers. Okay, the first one you're asking what happens if there is a break of slope in here. Okay, first this is pretty further away. This is a large move already. So that would stem from a threshold effect that is in your books. It's not. You see, I mean, there are some likely things, such as the relation between equity and credit spreads that are very nonlinear, that have threshold effects. But the threshold effects, they will typically happen here, not here. So the non-threshold effects, which are macroeconomic things, they will happen here. So that you can manage to account for it. And there is some type of asymptotic. So you just make sure that you draw your own line, your own estimate. You put some protection figure and you manage so that this black line be below whatever is your estimate. That's the way you have to do it. The mentality is that that's the way you have to do it. Now if you have specifically something here, that means that you have some exposure which is a hidden exposure, such as you sold an enormous put at a certain strike which is very low but that with a huge notional. In that case, I'm sorry, you have to behave like a classical risk factor. You sold it, you have an exposure, you have to report it. Now, if I'm telling you, okay, well then in that case, then you will estimate yourself what is the risk of that put, and then you have to behave like an insurance company, saying, okay, you have a cat bond or whatever, and then you have to say, okay, well in here, there is a risk which I bear, and I should report that risk one way or another. So either you speak of a specific risk factor like a cat bond, or it's a put, a very out of the money put, in which case what you say, okay, well, I put the figure and I have a risk, but I have my own reporting.
I'm conscious of the fact that we have now run out of time, and I apologize to the two people who wish to have a question. I hope they'll put that later. But to be fair to the next speaker, I think we should now move to.
Okay. And I will answer privately to your second question.